Every month, the same little ritual. The paycheck drops, the number updates, and for a moment, we breathe. Rent's covered, groceries might stretch, maybe there's even enough to save. Then the money hits our account, and it's already gone. Not because we spent it, because the bank did. They don't wait for instructions, they don't ask permission, they just put it to work for themselves. We're left staring at a number on a screen like it means something, but that number isn't money. It's a placeholder, because behind it, the machine is already running. We thought the bank was a vault, a thick door, a quiet room, a pile with our name on it. But behind the door, it's a casino, only we're not the house. We're the chips. So here's how the magic trick works. When we deposit money, it doesn't sit there. It doesn't rest. It doesn't wait. To the bank, our deposit is raw material, the base layer. They keep a thin slice available and use the rest as lending power. A small floor of cash, holding up a skyscraper of loans. That's fractional reserve banking. And it's not just theory. We've seen the proof in real life. If banks truly kept everyone's money sitting there, withdrawals wouldn't matter. Everyone could pull cash anytime, no drama. But that's not the system we live in. The system works because most of us behave the same way. We don't all show up on Friday at 5 p.m. and say, "Give me everything." We tap the card, we transfer, we move on. That's what lets the whole thing run quietly in the background. So our $1,000 doesn't stay ours in any real sense. It becomes the first chip in a chain. Loaned, spent, deposited somewhere else, loaned again. Not once, over and over. Like this, we deposit $1,000. The bank keeps a slice, say 100, and uses the other 900 to fund a car loan across town. The seller gets paid, drops that 900 right back into their bank. Now that bank has a fresh deposit. It keeps its slice, maybe 90, and lends the rest. Money out as a loan, money back in as a deposit. Same dollars bouncing bank to bank, and every stop adds another layer of credit on top of the same original base. And since 2020 in the US, one of the old guardrails got looser. Reserve requirements for many transaction deposits were set to zero. Not banks can do whatever they want, but the idea of a mandatory minimum cushion got watered down. So that number in our account, it isn't cash sitting in a vault with our name on it. It's a claim, a promise, a digital IOU. And that promise works under one condition: withdrawals stay normal. Because banks are always doing a timing trade. On one side, they owe deposits on demand, today, anytime. On the other side, their assets are loans, slow, long-term, locked up. Here's the simplest way to picture it. A bank can be rich because it owns a ton of loans, mortgages, business loans, long-term stuff. But those are like money locked inside a safe that only opens slowly over years. Depositors don't wait years. Depositors want it now. So the bank is always playing that timing game. Long-term assets on one side, instant withdrawals on the other. And as long as withdrawals are normal, it looks like stability. So a bank can look fine on paper and still be short on cash in real life. That's why bank runs happen. Not because everyone suddenly became irrational. Because the moment a crowd decides, "I want mine now," the math changes. That's basically what happened with Silicon Valley Bank. They had assets, lots of them, but those assets were tied up, long-term, hard to turn into cash fast without taking a hit. Then depositors got nervous and started pulling money out, and once it starts, it feeds itself. One person withdraws, another sees it, group chats light up, Slack messages spread. Suddenly it's not one person, it's everyone. Too many depositors pulled at once, and the whole thing seized. They didn't lose the money, they lost the timing. Loans move slow, withdrawals move now. When now hits too hard, the whole thing locks up. And when it locks up, the system moves fast, just not for us, because banks are treated like infrastructure. You don't let the bridge collapse to make a point. So instead of saying they are saving the banks, they say they are saving the system. Too big to fail and all that. That's also why they point to FDIC insurance. And yes, it matters. But FDIC isn't a magical pile of cash waiting to instantly repay everyone in a nationwide stampede. It covers up to a limit per depositor, per bank. And it works best when crises are isolated. One bank here, another there, not a full-on chain reaction. FDIC insurance is real, but it's not a superhero cape. It's not there to make everyone whole in a nationwide bank run. It's there to make sure the first domino doesn't knock over the next one. It's less "here's your money instantly," and more "don't panic, this doesn't have to spread." Because in banking, confidence isn't a nice bonus. Confidence is the operating system. And while we're being told to stay calm, banks make money in ways most people don't notice until it's too late. Fees, penalties, overdrafts, billions of dollars. And it's not evenly spread. According to the CFPB, most overdraft fees come from accounts averaging under 350. So the broke pay the most. The cautious get punished. The rich barely notice fees exist. And this is why banks fight so hard for deposits. Deposits are cheap funding. That's why they offer welcome bonuses and flashy apps and high yield accounts that still barely keep up. Because if they can get our money sitting there, they can lend against it. We think the bank is doing us a favor by holding our money. But the bank treats our money like inventory, something to deploy. And then the rich get to play the real game. They borrow against assets at low rates. They get better terms, relationship pricing. While regular people borrow at 15%, 20%, 25% through credit cards, often just to cover basics when rent and groceries hit first. So we deposit money and earn 1%. They lend money and earn far more. Then when we're short, they lend it back to us at predator rates. We fund the machine, and when it bites us, we're told it's our fault. If we run out of money, we're irresponsible. If they run out, they're systemic. And when their bets go bad, we pay for the rescue. With bailouts, with diluted purchasing power, and with the same old lecture about responsibility. What we see in the app is the calm version of the story. Behind it, the money is already moving, and we're told to stand still, to just save, to be responsible while the system isn't. Banks don't store money, they move it. And what we call our money is just our place in line, a claim. We carry the risk, they keep the leverage. They hold the switch. But the bank is only part of the story. The deeper problem starts with the money itself. The next video gets into that.